All right, good evening, everyone. My name is Xavier Duran. I am the Arts, Culture, Educational Programming Librarian for the Lisle Library District. A couple of things before. Can everyone hear me? I should start with that. If not, you might have to adjust your volume. Okay. I'm going to go ahead and continue because it looks like it's just a few or just one individual having trouble, but I'll go ahead and get started. My name is Xavier Duran. I'm the Arts, Culture, Educational Programming Librarian for the Lisle Library District. A couple things before we begin. We are recording this session and we are in what's called it's not in a presentation style, it's so much as kind of like an auditorium. So if you know that your camera is active and you do not want to be active, go ahead and disable your camera right now. There should be a camera icon that says video on the lower left-hand corner of your screen. I will also go ahead and mute you all for the time being, just because I know sometimes things happen where either the cat will jump on the computer and start meowing loudly, which has happened. Not here, but of course in other libraries. So I'll go ahead and do that now. With that said, bear in mind you might double check to make sure that you're not on camera. I will do my best to if you do not want to be on camera, especially if you are 3 tablespoons deep in some very delicious macaroni salad. So just keeping that in mind. With that said, I'll go ahead and hand this over to our wonderful presenter. Yeah, Judi Strauss.
Thank you, Xavier.
Oh, hold up. Something happened.
You click yes in that box for muting.
Technical difficulties. Yes.
Xavier, you've got me muted. Okay.
There we go.
First of all, I'm really happy to be here, even though I don't live in the Downers Grove or in the suburbs anymore. Lisle and Downers Grove and Woodridge have been in my heart because I ran my business and still running my business out of Downers Grove since 1969, which I won't tell you how long I am, but that's how long I've been running my program. And as many of you know, I also taught at Benedictine University from 1986 until I, quote, retired or left the university in 2002. One of the things I am hoping that some of you will show me your picture, because I used to love to come to the library and see you, and now all I can see is your name. So if you're willing to show your faces, I would like that. There's somebody else. Hello. All right. Good. Great. I'm going to start, and some of you I know, and some of you I don't. But part of the reason that I'm still doing this is because I feel like a lot of people really don't know what's going on. And I'm hoping that as a teacher and a tax person, I can help you. One of the things that I do want to tell you, and this is probably the most important thing that you need to hear tonight, is that everything that I am going to talk about will sunset in the year of 2025. For better or for worse, we just got a new president yesterday. He has a very different view of the tax laws than our last president. And every single law that we have in effect, or almost every single law that we have in effect, that was put into place in 2017 when Donald Trump was first president the first time, is going to sunset in 2025. So I want you to listen carefully. I want you to pay attention and really think about what's happening in Congress, because the next tax year may look very different than this tax year. The very first thing I want to talk to you about is the tax e-filing season will start on January 27th. What that means is you can file your taxes before then, okay? And most of us, including me, all filed our taxes by paper before 1996. In 1996, the IRS came into somewhat of the modern age and started electronic filing. What that really means for all of us is that when you do your tax return on computer, it goes from your computer to the IRS computer, and somebody doesn't have to key in the information. That's what's called electronic filing. Before we had e-filing starting in 1996, we used to send our tax returns in paper, and somebody would have to key in all the information from the tax return in paper into the computer and onto the IRS system. There was a 20 or 25% error rate in paper returns. Now somebody like me is mandated to e-file every single return unless somebody opts out, and it's substantially more effective for the IRS. Okay? Because if you e-file, I get, or you get an acknowledgement that your return has been accepted. That means it's made it through the first level of the IRS system. It doesn't mean that it's perfect. It just means that they've received it and there aren't any major glaring errors on the front end. Okay, that's really important. That doesn't mean, as I said, that you haven't missed anything or you haven't made an error. If you've made an error, you will get a letter from the IRS, usually within 3 months or 6 months. And if you're missing something, you will get a letter from the IRS, usually a year and a half later. And I want to say that because that's really important. The IRS does check what you get in paper or online from your W-2, from your retirement, from Social Security, from all of your investment accounts, and they match what you get and what they've got in your system. I don't know whether any of you have ever gotten letters that you forgot something, quote unquote, or that you've made a mistake. But if I have a client or somebody says to me, oh my God, what is this letter? Okay, then you know you don't have a problem, you just forgot something, or maybe you made a mistake. A really good example, and I do have people, not mostly my clients, but I do have people. I had somebody that called last fall, and he said to me, you know, I don't know why I keep getting these letters from the IRS. And part of the problem is he sends in his return in paper and he doesn't know how to do all the complicated calculations that the IRS requires. So almost always there's a mistake. Okay, so it's not a good idea to send it in paper. We'll talk about what's happening with the IRS later on in this program and what they're doing now. But for now, I'm talking about e-filing. And as I said, most of us are indeed e-filing. But that's why you should definitely e-file. The first second thing I'm going to talk about, which I think is getting newer. I will say it happened in the past, but I would say almost 90% of them now. We used to get our tax forms by paper. Most of you, and I can't see whether you're young or old from the computer, but most of us, including me, used to run to our mailbox and get our Social Security forms and get our W-2 and get our investment accounts. Okay, most of us have gotten our forms from Social Security already because they came right at the very beginning of the year, and they do come in paper. But indeed, most of us will get, I would say, 70 to 80% of our tax forms online in our computer. Whether you go to Fidelity or Vanguard or Charles Schwab or anybody, they really don't want to mail you out anything. There are two reasons for that. One, the mail is relatively unreliable, to say the least. Number two, it is substantially cheaper for them to post it on their website and have you print it out. And that's fine if you remember to print it out. I got some little notice in my email the other day from Fidelity that said, by the way, your tax form, or at least one of them, is posted on the Fidelity website. So I went in and one of them is posted. The rest of them aren't posted yet. So you have to keep remembering. It's really a problem if you don't keep your records together and make sure that you have all your tax forms. As I said, like even 5 minutes ago, if you forget something on your tax return that the IRS gets from Fidelity or Vanguard online and you forget to put it in, well, they find you absolutely. But you have to remember to look for them and make sure that you have them all. One of the things that happens now is all of those tax forms used to be available to us and required to be available to us by January 31st. That doesn't happen now. The stuff from W-2s should be available by January 31st. Your retirement form should be available by January 31st, but the investment forms seem to take forever. Okay, many of us have more than one investment account. They show up on February 15th, and sometimes you get amended or corrected returns all the way through the middle of March. You need to make sure that you've checked your records and saw what you had last year. One of the things that we'll talk about in a few minutes, you will discover many of us, including me, said, oh my God, I've got my money in a bank. Okay, I had a lot of money in Citibank. And I realized I wasn't getting any interest in this wonderful checking account from Citibank. So I talked to Citibank and they said, oh yes, you can open up a money market account. You can earn 4 or 4.5% on my money market account. So I opened up a money market account. It lasted a year. And then it went down to a lower rate. So then I moved my money to Fidelity. And now I'm getting 4.5% to Fidelity. So it's really important that you double check where you have all your accounts. I can't begin to tell you how many people have many, many more accounts. And they don't just have them at local banks, like the Bank of Lisle or the Downers Grove National Bank or Citibank. They have online accounts that are paying 4 and 5%. So it's really important to notice that, to make sure that you've got all of your 1099s. Okay, so what is actually still with us and what has changed? As I mentioned before, starting in 2017, they lowered the tax rates, and right now, those rates are still with us. The rates are different for what we call ordinary income and what we call qualified dividends and capital gains. Ordinary income includes Social Security, W-2 wage income, interest income from banks, money market accounts, retirement accounts, annuities. Those are called ordinary income. They are taxed at the highest rate. If you have money in mutual funds that are invested in stocks, okay, or if you have mutual funds or stocks that you sold, those are called qualified dividends and long-term capital gains. And we'll talk a little bit more about long-term capital gains in a couple of minutes. Qualified dividends and long-term capital gains are taxed at a substantially lower rate. If your income is lower, they're taxed at 0. If your income is higher, they're taxed at 15. And if your income is really high, they're taxed at 20. So one of the things that has happened to many of us for this year, especially as we get substantially higher interest, we're paying more tax. And we don't even realize it until we get our 1099 and then I say, oh my God, I had this much interest last year and now I have this much interest. When I did clients last year, which is when the interest rate started to rise, I'd have people with maybe $1,000 worth of interest, and then it went up to $5,000 worth of interest because they didn't realize when they put the money in the bank, you're getting more interest. Even though you don't take the money out of the bank, the interest is still taxable when you earn the money. And that's really important to look at. Most people don't realize how much money they're actually making until the money starts floating through there. Okay, and so you really need to look at your interest rate and see what's happening because you don't realize that you're actually paying that much. The second thing and the other thing that happened in 2023 and also happened in 2024, which is a pretty scary thing if you look at your year-end statement, the stock market went from here all the way up to here in 2024. It did that as well in 2023. If you own mutual funds that are invested in stocks, then you don't have control. You have control of whether you sell the entire piece of a mutual fund, but you have no control over what the fund manager does. So many fund managers, given what we thought, and we still don't know what's happening after this election, said, okay, at the end of 24, the stock market went like this. We're going to sell some of the mutual funds because we think the stock market is going to do this in 2025. It hasn't yet, but it still may well. So just to give you a funny example, not so funny. I had a client that sent me an email. He now lives in Florida. I do clients all over the country now when they move. And this client sent me an email and said, I think I have a problem. What was his problem? He had $65,000 in long-term capital gain distributions from mutual funds. And when I figured his taxes and we sort of projected what we thought was going to happen, we figured 20. And he had $65,000 worth of mutual funds. That's a whole lot more tax than we expected. So that's something that, again, if you invest in a mutual fund in Vanguard, in Fidelity, in T. Rowe Price, in Vanguard, those mutual funds that you really don't expect to kick out capital gains, kicked out capital gains, and they usually happen in December, and you have no control. If you own individual stocks, you can buy and sell as you wish, but often, if you own mutual funds, which most of us do, that's not in an IRA, but in a regular investment account. People are surprised at what happens, and I try and look at what's going to go on with that. So that's number two. Number three, in 2017, they did something that made it easier, but also caused a problem. They doubled the standard deduction and they got rid of all the exemptions. That is still with us through 2024. We have absolutely no idea what's going to go on. So the standard deduction is really big. There's an extra, let me see how much it is. An extra $1,550 if you're over 65, and it's an extra $1,950 if you're single and you're over 65. So we do get a slight break if we're over 65, but there are no exemptions. So most of us, and we'll talk about itemizing in a little bit, but most of us starting in 2017 haven't been itemizing our deductions. We used to itemize our deductions using our real estate taxes, our sales taxes, our mortgage interest, and our contributions. But most of us are not doing that anymore unless we have really big medical, which I will talk about. But the standard deduction has doubled, and also the deduction for taxes is limited to $10,000. Now in Lyle, maybe our real estate taxes are 6 or 7 or 8, but it's limited to 10. So it's really hard to get way above the standard deduction. And many of us who are older, thank God, own our own homes, so we're not paying a lot in mortgage interest. A lot of the people maybe, and as I said, I can't see whether you're old or young, but I was just in Austin last weekend. I have a grandson that got married and my very first great granddaughter, and they're looking to buy a house. And they figure their monthly payment is going to be like $5,000. To me, that made me crazy. But again, if you have a mortgage payment of $5,000, imagine how much interest you're paying. So you might well be itemizing your deduction, or your kids might, if you have a very big mortgage on your house and the rates are pretty high now. So we'll see. Okay. Now, something that is important that really did change, and you need to listen to this, is what's called required minimum distributions. This is a very important part of the tax law. Most of us have a lot of our investments in our 401ks from work or our IRAs, so that we have retirement accounts that grow before you turn 73, okay? And then hopefully you have other income that are non-retirement accounts. Before 2024, okay, or before 2023, you had to start taking your money out of your retirement account. It was called a required minimum distribution when you were 70 and a half. Okay, they didn't want you to keep it in there forever. They wanted to get the tax money on it, because the money that you put in retirement accounts at work or in IRAs are tax deferred until you take them out. And so starting, if you were 70 and a half before 2023, you had to take out an RMD every single year, okay, starting at 70 and a half. And starting in 2023, you had to take out a required minimum distribution when you were 73 years old. That 73 number is going to continue until 2033. Now, how do they figure a required minimum distribution? Okay, they figure it this way. They take the year-end value of your IRAs, and some of us have one and some of us have a lot more than one, okay? And they divide that by a number from the IRS, what's called life expectancy table. So what happens is, when you're 70 and a half or 73, your life expectancy is higher. And if you're older, then your life expectancy drops every single year. So you take the value of your IRA based upon December 31st of that year, and you divide it by the number in the life expectancy table, and that's what you have to take out. Now, you can take your RMD out of each IRA if you have more than one, or you can take it out of one of them. It doesn't matter as long as you get your required minimum distribution out of there, okay? And if you forget, there used to be a huge penalty on the IRA books And now they've reduced it because unfortunately, most of us are not perfect. And I have clients that call me up, and I won't say they're hysterical, but I will say that they're concerned that they forgot to take out their IRA. I'm talking to somebody again tomorrow where the mother is 80 something and she has dementia and they forgot to take it out. And so we try and just make sure that we get it out as fast as possible. But again, they realize that people are perfect. Now, this RMD, also they revised the table because part of the reason I'm in the city is my husband died in 2019. It's 6 years already, and he died at age 93. So his life expectancy wasn't here, it was way down here, and he had to take out a whole lot of money. A lot of people are really worried about running out of money from their IRA, so and people's life expectancies are longer, okay? And so you can take less money out every single year. Besides the long-term capital gain distributions, many people are surprised because, again, the value of your required minimum distribution is based upon the value of your IRA at the end of the year. 2 years ago, the stock market dropped in December, and most of us had to take out less. Last year, I had to take out like $17,000 more than I took out the year before. And this year, if you look at your IRA, you're going to take out more. One, because you're older, and two, because the stock market did very well at the end of the year. It's both good news and bad news. You have more money, and you have to take out more, and you have to give more tax. And so, again, part of this is a really important thing. One of the things that is absolutely critical, I think there are a couple of questions, and I will answer, I'll look at it in a minute. But this is a very important thing that happened starting in 2017, and I really want to talk about it more than just a little. It's called a qualified charitable distribution. I said about 5 or 7 minutes ago that most of us aren't itemizing our deductions. One of the really wonderful things about itemizing is we used to give our money to church or other charities, and it would be a win-win situation. We would give the money away to a good cause, and we would get a tax deduction. Well, now people aren't itemizing. So this is a very important thing to do where you can get what I'm calling a win-win in taxes. So if you're taking money from your IRA, you can designate before you get the money, and this is critical, and you can tell Schwab or T. Rowe Price or Vanguard or Fidelity that you want to make donations to charity from your required minimum distribution. The check doesn't come out made to you. The IRA trustee makes the check or checks out to the different charities and sends the check to them. Your IRA distribution, just like your pension money, if you've got one, comes out on a form called a 1099-R. R stands for retirement. Okay, the code on the retirement from an IRA is a code 7, which means it's your regular retirement account. It won't look any different if you gave money to charity from your IRA or if you didn't. So how do you get the tax break? And this is very important. There is a screen on my tax program for the IRAs. You put in the information, so there is the gross amount and the taxable amount. It will look exactly the same on your 1099-R. I will then pull up a little box on my computer screen, and it will say QCD, which stands for Qualified Charitable Distributions. And I will say, okay, You gave to the Lyle Methodist Church 4,000. You gave to the Red Cross to help California 2,000. You gave to Doctors Without Borders 2,000. We will total up the qualified charitable distributions, and it will subtract them from the amount that shows up on the side of the 1040 where it's taxable money. And on that line where the 1099 shows up, it will say on my computer QCD for qualified charitable distribution. Now, that is important because then you're getting the benefit from the charity that you wouldn't have gotten if you didn't itemize your deductions. And for example, I have several different retirement accounts, and on one of the small ones, I give it all, because I'm still working, I give it all away. And I tell them where I want the money to go. Now, why is this important for some of you? If you go to church, and churches are getting much better at this, they used to pass around the basket every single week, and you'd put an envelope or you'd put cash into the basket, and they tell you how much you donated during the year. I now have clients that give the money to the church in one fell swoop, whether it be 1,000 or 2,000 or 5,000 or a lot more than that. I think there's Saint Scholastica and Lyle and some other really big ones. And so they get their money in a big lump sum instead of every single week. And it's a win-win. Okay, it definitely is a win-win. So the church gets the money and you get the tax deduction. But the qualified charitable distributions are really important. If you were a client in my business, I would run the numbers and show you how much tax you would pay without the QCD, and then I would show you how much tax less you would pay with the QCD, so that you know how much you're saving. Now, there's something else that's really important about this, okay? I've said a little bit ago that your interest went up, your capital gains went up, okay? Social Security, and we'll talk about it in a minute, goes up a little, but there is a formula in Social Security, and I'll explain it shortly, that says that if your income is higher, up to 85% of your Social Security is taxable. So if you give your money away in QCDs, it lowers the amount of your income. It might lower the amount of Social Security that's taxable. It definitely will reduce your tax. So it is a very big win-win situation. The other thing that is really important, okay, that happens a lot with people now, as your income is higher, first of all, we live on what we get in our bank account, okay? Most of us don't consider our interest income or this income from investments as part of our regular income. I have a client that says to me, Judy, aren't you taking your dividends and capital gains and living on them? And I said, no, but guess what? We're paying tax on them, whether we have them in our bank account or we're spending them or we're not. If that money shows up on a 1099, it's taxable, whether you're buying something with it or you aren't. If you're like me, and I think like many of you, I have this very old-fashioned feeling like I have a very big comfort zone to keep the money in the bank or to keep it in my investment accounts. And I look at it and I feel more comfortable when I have money that I can say I can grab or I can use when I want to. Even if I don't spend it, I feel comforting that it's there. But then when I look at my 1099 and I said, oh my God, how did I make so much money? Then I have to pay tax on that money. Well, another problem, and I guess it's a problem for more than just a few of us, about 6 or 7 years ago, because Medicare has been running out of money, they decided that taxpayers that had higher incomes, whether you're single or whether you're married, okay, or widowed or whatever you are, if your income is higher at certain levels, you have to pay more for Medicare. Now, Medicare this year is, I don't remember how much it is, I'll be able to tell you in a minute. I don't remember where it is. I'll look in a second. But I don't, it's on something that I have. But if your income is high enough, you actually pay more than the base rate for your Medicare, and you pay more than the base rate for your drug plan. So if you start giving money in qualified charitable distributions, it's going to lower your taxes, okay? And you might wind up paying less for your Medicare and your drug plan. That's really important. One of the things that happens, and I'll look at the numbers that I have sitting next to me in a minute, but Social Security and Medicare and the IRS compare numbers sometime in the middle of the summer. And while I absolutely hate it, I get a letter from Social Security and Medicare. Usually it's around November. And part of the reason is because I am old enough and I'm still working. It's because you get, they exchange and they then tell you how much in the next year you're actually going to pay for Medicare and your drug plan. Now, the good news is that computation is a year by year computation. So if you made more money in 2024 when I do your taxes, you will get a higher Medicare and drug plan bill each month subtracted from your Social Security in 2026. And if your income goes down the next year, you won't have that surcharge. But that's in there for every single year that your income is higher and you get a letter. Okay, and so if you do these QCDs, okay, then it's based upon your total income. Okay, and the Medicare is not just based, and this is an important thing, it's based upon your adjusted gross income, but it's also based upon your non-taxable municipal bond interest. So you think you're saving money in Illinois, but then you're getting hit by the Medicare and the Medicare drug plan. So this is a really important reason to do what we call qualified charitable distributions. And I don't know, I can't see because none of you are raising your hands, but I can't see that. Somebody else has a question. Okay, now everybody's okay, so I don't have to worry about it. If you have a question for me, and it's a question that you think other people want to have an answer to or you're not clear, please put it in the chat. Okay, I can't answer questions that are specific to your own individual tax situation, but if I am not clear, or if there's something that I haven't talked about that you want to answer to, please put it in the chat and I will make sure that I have answers to. Okay, now there's something else that's very important it's new, but it's also really new in 2025. So if you have an IRA or a 401k, okay, you have what we call beneficiaries. If you die, then your beneficiary inherits your IRA. So that my husband had several retirement accounts, and when he died, I agreed, it was my second husband from Downers Grove, and I agreed to give his 3 children half of his IRA money, and I inherited half. So I am what is known as a spouse beneficiary, and his 3 adult children were known as non-spouse beneficiaries. That is very important, and I'm going to explain why right now. A spouse beneficiary can roll over the IRA into my name. It is called an inherited spouse beneficiary. I can take the money out just like I'm taking out my own IRA under my life expectancy, and I can stretch it. Okay? If I am one of my stepdaughters or one of your children or whoever else besides your spouse inherits the money, up until several years ago, they could stretch the IRA also and take out a little bit every single year. The IRS didn't like that. They wanted to get more tax money after 2017 when they lowered the rates. And so what happened was they changed the rules on inherited beneficiaries, and this is very important. As I said, I can carry on my IRA for as long as I'm alive and take out a little bit, the one I got from my husband. But if you're a non-spouse beneficiary, the interim rules said that you had to liquidate your inherited IRA by the end of the 10th year. Well, that sounds pretty good. Okay, so people said, okay, I won't take it out. I'll let it sit there. Usually, if you're a non-spouse, you're still working. So if you're inheriting an IRA and you have to take money out every year, it raises your taxes and you're paying tax at the highest possible rate, which is called your marginal rate. Okay? And so many people didn't take out any required minimum distributions from inherited IRAs. Well, the IRS finally got around to last year to changing the laws. Okay? And here's what they did, which you won't like very well at all. So they said, starting in 2025, everybody has to take out a required minimum distribution. So if you didn't take any out and somebody died after 2019, you've been letting the money grow. Well, the good news is that it grew. The bad news is by 2029, you have to get it all out of there. You haven't been taking any. So now you have to take a whole lot out starting in 2025. You have to take out a required minimum distribution based upon the value of your inherited IRA, so that by the end of 10 years, the value of that IRA is 0. So this is going to be a very big mess for a lot of people from inherited IRAs. Okay, you're going to have to, starting in 2025, you'll get a notice from the IRA beneficiary, and you have to start taking money out. Now, you can do these qualified charitable distributions from an inherited IRA, and I do. But if you give the money to your grandkids, or you give the money to a friend, it has to go to a qualified, what's called a 501c3 charity. And so it has to go to a charity if you're going to do that. But that is a very big change, and you'll be surprised at how much money, especially if you haven't taken any out at all, that you have to start taking out to totally liquidate that IRA. If the person died after 2019, you're going to have to play catch up and get rid of the entire IRA by 2025. So that becomes really important. Okay. Okay, do we have any other questions so far? My God, you're doing really well. All right, so I'm going to talk about a couple of other newer things that are important. Okay, first of all, I want to tell you, I told you about banks. I also want to talk a little bit about savings bonds before we move on. A lot of us have savings bonds. I used to buy, my mother, my father, my grandparents used to buy savings bonds for me and my kids. Okay, we had them in paper. Remember them? They lasted 30 or 40 years. Okay, and so now there is a wonderful website called Treasury Direct, and you can figure out when your bonds, based upon the code on the bond, when they're going to expire and how much interest there is. I have clients that come into my office. Well, they don't come so much anymore, but they used to, with bags full of savings bonds. And we would do a listing. I can do it online, and I can tell which bonds have expired. Okay, when the bonds expired or when you decide you're going to cash them in, what you used to do is you would take them to the bank, you would cash the bond, and the interest from when you bought the bond to when the bond matured or you cashed in, again, is taxable interest income. It is United States interest, but it's taxable interest income. Okay, and a lot of people, we would then do a plan to make sure that that you weren't collecting that much interest in 1 year. Okay, a lot of people don't even realize that they have bonds, okay, until we start doing this listing of bonds. I have a client that last year she had $124,000 of interest from matured bonds that her husband bought at work over years and years and years. Okay? What happens now is that they really want, and there's this, as I say, website called Treasury Direct. So some people cash in their bonds at banks, other people, and an easier way to do them is to send the bonds to Parkersburg, Virginia, or Minneapolis, and then you have an online account with Treasury Direct. That's fine. It's easier, so you don't lose the paper bonds, and then you also can know when they're maturing. But if you've got an online account at Treasury Direct, the instant second that they mature, they cash them and they credit you with the interest, and they stop paying interest. So again, it's easier to manage, but that you really don't realize that you have these bonds. Now, the good thing about Treasury bonds or US government bonds, or what we would call E-bonds or now I-bonds, is that they are taxable federally, but because it's government interest, they're not taxable by the state of Illinois. So they are a subtraction for the state of Illinois. But it's really important, and if you inherit savings bonds, if the bonds say either payable on death or transfer on death, which some of them do, it takes forever, and we have to go through Treasury Direct because they won't let you keep the paper bonds. You have to transfer them to an online account, and we have to fill out 2 or 3 different forms with Parkersburg, Virginia, and then there's an online account. I strongly recommend that you go to your safe deposit box and see what you have. Many, many, many of my clients have savings bonds that have matured, that have not been cashed. One of the advantages is that they've earned a lot of money, and I had one client that cashed in her savings bonds and bought herself a car. Okay, after the tax was taken out, but that's really important. Okay, so that's something else that's critical. Another new thing that happened last year that I want to talk about, and I didn't have a single client in 2024 that did this, is that there was always a law, a tax law on the books for energy credits. If you got new windows, if you got a new furnace, if you got a new water heater, okay? If you put in new insulation, as long as your energy saving things met what we call Energy Star requirements, and there is a website called www.energystar.gov. As long as it met certain requirements, you got a tax credit. What a tax credit means is you figure your tax and it subtracts the credit from that, like a child credit. The law before last year was there was a maximum, a lifetime maximum of $500. And once you reach that max, no matter what you did, it didn't matter. Okay? They totally changed the law in 2022. Okay? And the law before 2022 was only for your main house. It wasn't for a summer home. It wasn't for some other resident. They changed the name to the Energy Efficient Home Improvement Credit. Okay? And what this means is if your energy improvements meet Energy Star requirements, every single year there is up to a $1,200 credit with no lifetime max. So if you decide you're going to do windows and you look at the form and you get this credit, okay, you do some windows this year, you do some windows next year, you bought a new furnace, okay? One, it's a win-win. You're getting an energy efficient piece of equipment and you're getting a huge tax credit. It can be claimed for windows, doors, heat pumps, water heaters, all sorts of things. And so I'm really suggesting that you seriously consider getting it as long as they meet Energy Star requirements. As I said, it also is good for a second home, okay? And we have a worksheet on that, and you can look at the website. It's pretty cool, and they should tell you, okay? So this is something that's very, very, very important. And as I said, I have one client, we were all excited. He figured out how much he put in, and he didn't have to pay any more estimated tax because he's saving the credit. And so he paid a lot of money for his energy efficiency. I think he did all his windows. I think one of the funny things, and I have no idea what happened, from when my kids were little until I sold my house, I lived on 62nd Street in Downers Grove. Okay? I never replaced the windows. I never replaced the windows. I drove past about a year and a half after I sold the house, and the lovely family that bought my house replaced every single window in my house. Okay? They changed the entire outside look too. They changed the siding, but they changed and replaced every single window in my house. So that was absolutely cool. I loved it. Okay? And so that's really the most important thing with the energy credits. Are you okay still? I can't see any of you because you're all hidden. But now I'm going to talk about a couple more things. Number one, I'm going to talk about something that the IRS started several years ago, and this has to do really with identity theft. I am finding, and I'm sure you are finding, whether we're old, whether we're young, whether we think we're smart, or whether we think we're not so smart, we get emails all the time. Okay, We wonder whether they're bogus. We wonder whether we ought to open up something somehow. And I've done this as well as you have. You wonder what the H you did with this credit card. Okay, did I lose it? Did somebody lift it from my pocket? Okay, what happened to it? Identity theft is rampant. Okay, it's not just rampant with the IRS, but it's rampant all over. I have a really good friend who, unfortunately, and I have clients as well as friends that has dementia. And twice in the last year, she had her debit card in her pocket when we went out for coffee, and somebody lifted it. She didn't even realize it. It was a disaster. It was a mess to get it solved. The IRS has had huge amounts of identity theft. Somebody gets a hold of your social security number. They can dummy up a W-2. They can dummy up a tax return. They can file way before you. They can get the refund from the IRS. You file and your e-file gets rejected because somebody has already filed under your social security number. It is an F mess. Okay, so the IRS tried to figure out what they were going to do. And here is what they do. They have a system that's called identity protection pins. There's a place on the screen at the very beginning of the tax return program that I use, or probably if you do it online that you use. You get an identity protection pin from the IRS. You put it in the tax program before you file, or I put it in. And then the IRS can match who you are with your identity protection pin so that nobody else can use your tax return. Okay, I've already told you that the probability you're going to file your tax return really early is small. Okay, I probably don't get really busy until the beginning of March. Okay, because people are waiting for all their stuff. But these identity protection pins are important. If you had identity theft, the IRS requires you to have an identity protection pin. You can get one. Your spouse can get one. Okay, so what is the downside of an identity protection pin? There is a downside. The downside is the one that you used last year won't work for 2024. You have to get another one. You have to go through the IRS system called ID.me, and you have to get a brand new one every single year. If I put in the identity protection pin that you had from last year, your electronic filing will get rejected. Okay, so it is a major problem. We had a client about 2.5 years ago in my office when I had a temporary office after I sold my house. And I thought the wife was going to kill the husband because he got one the year before and he thought he could use it over again. And then he didn't remember how he got it. And they had to come back in my office and I had to help them get a brand new identity protection pin. It's not quite as difficult now, but it's really important to make sure that you get one if you really want it. You don't have to have it. I actually don't have one, but a lot of people are terribly nervous and they feel safer having one. It's called an IP pin, and you have to get it online. You can get it through the IRS website, which is called www.irs.gov. You can look for it and you can get one. But if you're going to get it, if you're a client of ours, my office manager, which many of you have met, she used to come to the workshops when I used to come out to Lisle. Beth keeps a record, and we actually remind the people that are my clients, don't forget to give us your IP PIN, otherwise I can't get your tax return correctly e-filed. So this is a very important thing for you to know. Is there anybody you can put in the chat that has an IP PIN? Nobody. How many people have had their identity stolen? I have not, but other people I know have, and I've had lots of clients that have had their identity stolen. There's somebody that opened up. I can't tell whether she's had anything, but I just really want to say to you, you think that this is a problem of older people? My grandson, who's now he's 30, is going to be 31. He didn't check his checking account. One day he checked his checking account and most of the money was gone because somebody stole his identity and got into his online account at Chase. Okay. I also would strongly suggest that you watch your bank accounts all the time. I do. Most of us watch our bank accounts. The younger people don't even, not only don't they watch them, they don't even balance them. Most of us and most of the clients that I have, I balance my checkbook. I make sure I look to see where money is coming out or when things have been charged to me. But oftentimes the younger people don't look, and then things get out of control before they realize they have a problem. So this identity protection pin is a really, really important thing. Okay, something else that I want to talk about has to do, somebody has a question. Oh, somebody said, somebody tried, hold on, I wanted to read that, the chat. Somebody tried to get all of my IRA money out of T. Rowe Price. They were able to change my password and email address, even though I had what's called two-factor identification. It is a problem, okay? And that's why I strongly recommend that you watch your accounts. Okay, we'll talk about passwords and IDs in later on in this talk, but I think it is a major problem, and you don't realize that it's happened until way after it's happened if you don't pay attention. Many of us, for better or for worse, are very busy, and or we tend to just think, you know, they can't get us. Well, you know what? They can get you. They don't call anymore. Do you remember when you used to get these bogus telephone calls and you hang up on them? Now they send you a text, and now they send you an email. I can't tell you how many emails and texts I get that are junk on my phone every single day. Almost anybody where you buy anything from, they call and they say, give us your email so you can track when it's going to get delivered. Okay, here's somebody else that had their identity stolen during COVID. Okay, from unemployment. Okay, unemployment actually in Illinois had a major problem, okay? But they're doing better at this kind of stuff now, but it's been a major problem. This identity theft has been a major problem. And I'm just telling you, I'm not strongly suggesting that you get LifeLock, although I will just tell you, I think I know when my experience was, so you'll know. I was living in my house in Downers Grove, and it was the year my husband died. And I went and I posted a really beautiful obituary in the newspaper. And I have a website for my business, which I'll talk about in a little bit. And I came back from vacation, and the mail lady who knew me well, because I get lots of mail, said to me, oh, I thought you moved. And I said, you thought I moved? She said, yeah, we've been forwarding your mail for 3 weeks now. I said, you've been doing what? Well, somebody filled out a forwarding form at the Woodridge post office, and my mail was being forwarded to someplace on the southwest side of Chicago. It was a mess. I had to change every bank account. I had to change every credit card. It was a god-awful mess because they found me online from the obituary. Okay, so this has been an ongoing problem. All right. Something else. A lot of us are not so young. A lot of us think about whether we're going to sell our house I lived in my house in Downers Grove from 1969 till 2021. Okay, we bought it for, my ex-husband and I bought it for 42,000. Okay, we think about whether we're going to sell. If you're selling a stock or if you're selling a mutual fund, the difference between when you bought it and when you sold it is considered profit. What happens with a house? Okay, I mean, that's just besides the fact that you might have to clean it out and you might have to fix it up a little bit. You might have to paint it or do whatever you're going to do. Here's what happens with a house, and I think this is a wonderful thing. Okay, you start with what you paid for the house. You add in what's called all your capital improvements. Like in my house in Downers Grove, I redid the bathrooms, I redid the kitchen, I put on a new roof, I had a new furnace, I had a new air conditioner. Okay, we did a lot of landscaping. It's anything that you do to a house that makes it be worth more. So you start with your cost and you add on all what we call your capital improvements. It's not a repair, it's a capital improvement. That's what's known as your basis. Okay, you then sell your house and you get the selling price and you get this whole big closing statement, and it is the you take your selling price and you subtract all the expenses of the sale. Okay, that is called your net selling price. The difference between the net selling price and the basis is the profit for the IRS. As long as that profit is not more than $500,000 if you're married, or not more than $250,000 if you're single, then you're going to pay no tax. That doesn't mean that you don't have to report it, but you have to you have to show it, and then you have to show that you're eligible for the exclusion. As long as you've lived there 2 out of 5 years, then you can do an exclusion. So if you moved from Lisle and you decided you're going to move to Florida and you got an exclusion on your house in Lisle, and then you decided you were in Florida and you were going to move to a retirement community, you could take the same exclusion as long as you lived there 2 out of 5 years on your Florida house. Okay, so that's real important. Okay, and it's very useful. Now, I owned my house by myself in Downers Grove. Okay, but if I had owned it with my husband, then I would have gotten what we call a stepped up basis for half of the value of the house up to when the date when he died. So we do a lot of figuring when people sell their house, and most people don't pay tax on their house profit. Now, if you lived in California before the fires, I have a relative in California. She paid $300,000 for her house many, many years ago, and it was worth $2 million. Would she have profit on her house? A whole lot. It probably isn't worth $2 million today after the fires. She didn't lose her house, but there was huge amounts of smoke damage. But even the values of all the houses in California dropped dramatically. But again, that's only on what we call your principal residence, your main house. If you have a second house in Wisconsin, in Michigan, in Florida, and you decide you're going to sell that house, you will have to pay tax on the profit. So if you have a second house and your house is in Michigan, okay, we have to figure out what the profit is on that house, and where do we have to pay tax? We have to pay tax in Michigan. And then we get a credit for the tax that's paid in Illinois. And as I said, I have clients that have moved all over the place, okay? And they pay taxes on the state where they sell their other house. So it's a really interesting kind of problem, and we do taxes all over the country now, for better or for worse. I do, and many of my clients are in retirement homes in different parts of the country. Okay, so they don't qualify. If you make money in another state, you also have to pay tax in that state. So we do lots of state taxes as we speak now. I think the next to last thing I really want to talk about, and this is an interesting kind of problem, for more of us than used to be. When I've been talking, I want to say one other thing. Illinois' tax is a flat 4.95%. It's been there for a long time. It is on all income except retirement income, like IRAs and pensions. Okay, it's a flat tax. There is an exemption in Illinois. It went up from 2,400 to 2,700, but otherwise it's an absolutely flat tax. And there is a credit for 5% of your real estate taxes, but that's all Illinois is. And when I talk about Illinois in a minute, they've been trying for several years now to raise the state income tax on much higher income taxpayers, and it got defeated, not in this past November, but in the November before it got defeated. I don't know what's going to happen. Most states have graduated income taxes. Okay. So the next to last thing I want to talk about is what's called the estate tax. Another name for the estate tax is what is called the death tax. And we've been talking about income tax. That's when you earn income. The estate or death tax is on the value of all of your assets when you die. The federal estate tax exclusion under Trump was raised to 12 million. It's almost 13 million now. Okay, most of us, including me and most of you, don't have that kind of money. Okay, but even though most of us, including me, don't feel rich like some people we know, we have more money than we used to. We have it in investment accounts, we have it in retirement accounts, we have it in our house, we have it in IRAs, we have it in annuities, we have it in life insurance. Okay, there is a form if you're very well off, called the estate tax. It's a 706. And if your income is, your value of your assets is way above here, you pay the federal estate tax. The exclusion in the state of Illinois, and I'm going to say it in a funny way, is only what we call 4 million. Now, 4 million when I was growing up felt like forever. Today, 4 million doesn't feel like enough, a lot when you figure out all of your assets. Okay, so if you start looking at stuff, my boss from Benedictine died January 3rd. Does he have 4 million in his retirement account? He does. Okay, so what happens is, which is really a big, huge part of my business now, if you have more than 4 million, and this is each person, then I have to figure out the federal tax, because the Illinois tax comes off the Illinois 700 comes off the federal 706. It takes forever to figure out the form. They want backup of every single asset that you have, including your jewelry and your art and your cars and everything that you have, appraisals of different houses. You'd be surprised at how much you have when you don't think you have it. And believe it or not, the last one that I did last year, it took 18 months to get a closing letter from the state of Illinois. And the beneficiaries who want the money like yesterday, I tell them that they really they shouldn't be getting most of the money until we're sure that there isn't any liability. So this is a very big problem. On the flip side of some of this, and people ask about this as well, if you decide you have a child or a grandchild that you want to help out, you're allowed to give away in 2025. In 2024 it was 18,000. In 2025 it's 19,000. You can give away that much money without doing any paperwork. As long as you don't give away more than $1 million, there's no tax. But if you give away less than now it's $19,000 per person, then I don't have to fill out any paperwork. Like this lovely grandson that I have with his wife and his new baby, they're looking, thank God, to buy a house. And I said to them, along with his wife's mother, excuse me, I will be really happy to help you. I'd rather help you while I am alive than if you inherit it after I die. And so I'm going to give them money, but no more than $19,000 to him and $19,000 to her. If it's more than that, I have to fill out a form called the gift tax, and we have to reconcile it when somebody dies. But a lot of people feel, some people get scared about giving money away, and other people say, I'd rather see you do something good with it. Maybe you need to buy a car. Maybe you need to pay off student loans. Maybe you need to buy a house. Maybe you want to go on a really nice vacation, or somebody wants to do something and you want to help them with something, that you want to give them a gift that comes from your heart, and then you see them as that they can use the money now. A wonderful example, years ago, I gave the same grandson money, and he bought a car and he named it Grandma Judy's car. Okay, and now the car died, and they're going to get an SUV because, you know, they've got a baby and huge amounts of stuff. But I gave him money, okay, not all of it, but some of it, and he used it to buy a car when he graduated from graduate school. So that's the gift tax. Now, probably a couple more minutes. So also, I really want to mention, included with this, that you can have a will, you can have a will and a trust, and you can have financial powers of attorney, and you can also have healthcare powers of attorney. When you die, your will and or your trust determine what happens to your money and determines what happens to your taxes. I have almost 1/3 of us don't have either a will or a trust. I can't begin to tell you what a mess it is. Okay? Because that is the legal document that I have to look at that tells me what's going to happen tax-wise. So oftentimes when the first spouse dies, it says that the living trust becomes an irrevocable trust, and then all the money has to go into this trust, and then the spouse gets all the income from that trust until the second spouse dies. So what happens to Judy and what happens to you is I have to do, and that new trust is called an irrevocable trust and not a living trust. And that new trust is not under your social security number, but is under a new number called an employer identification number, or an EIN. And instead of doing one tax return, I have to do 2 tax returns. I used to do maybe 5 of them a year. I'm probably doing 50 now because my clients tend older And again, where is what I have to do and what you have to do? It's written in your trust document. But I have probably I don't know what's going to happen now, but I have a client, and I didn't realize it was the second marriage. The husband is much older. And I got a call from the son-in-law. And so they lived in Downers Grove. Now the husband is in a nursing home in Oak Park, and he is in his 90s. And the wife has Alzheimer's with psychotic seizures, and she's in another nursing home full time. Their income is this big. The kids are going to now have to manage the money. The husband is somewhat copacetic. Hold on, I'll look at the question and I'll answer it in a minute. The husband is somewhat copacetic, and he was able to fix his trust. The wife's trust is 20 years old, okay, from some ex-husband that's listed as a beneficiary. She can't change it. She's too far gone. She's too far gone. The trustee is her brother that she's estranged from. So now the son-in-law and the daughter of the husband, who are in their 60s and just retired, guess what they're going to be doing for the next 1,000 years? Not only taking care of the parents, but dealing with this money problem. Okay? And it's a mess. It is really a mess. I am not a lawyer. I know how to read trusts. I work with lawyers in Lisle. I work with lawyers in Downers Grove. I work with lawyers in Wheaton. I work with lawyers in Hinsdale. I work with lots of lawyers downtown. And from the bottom of my heart, please look at your will or trust and make sure it's up to date before I have to read it. And then I say, oh my God, what did you do? Okay? So, that's something that's real important. And I can't tell you how many of them I'm doing. Somebody has a question down here. I want to answer it. Okay. Somebody said, if you lend money to a family member to buy a home, do you need to? Okay. This is a good question. So let's assume that instead of giving money to my grandson, I'm lending him money and I'm carrying a mortgage for them. Okay. And they are paying me, instead of paying the bank interest, they are paying me interest. The answer is yes. You may not need to file a mortgage interest form, but there is a place on the tax return. If you are earning interest on that mortgage, then you have to declare the interest as income, just as if it was income from a bank. And there's a place on Schedule B that's called seller finance mortgage. And you have to include that as income. The person who has the mortgage from you, then if they are itemizing their deduction, there is a place on the itemized deduction form where they need to put in your name, your social security number, and how much interest they paid you. So you don't have to fill out a form 1098, but you do need to report either the income or the interest paid. So that was a good question, okay? And that's important. And I do have clients that carry the mortgage. Now, having said that, well, it's later than I thought, but we're okay. Having said that, let's assume that you're doing that, and then it says in your will or your trust that if I die, I'm going to forgive that mortgage, and those people are going to inherit that money. Then you may want to adjust your will or your trust so that you're not giving more money to this side of the family than to this side of the family. Because I can't tell you how often it happens when I start reading wills or trusts or working with families that this thing was written a really long time ago, and now we've got families that are fighting. I have one client, and this is probably, I haven't finished dealing with it yet, but the father and mother died within a day of each other last year. And apparently, when they wrote their trust, their daughter had some emotional problems. And so they decided that her share of the money was going in what's called a special needs trust, and she couldn't get it at all. She could get the income, but she couldn't get what we call the corpus of the money. She's fine now. But the trust was written that way. The son has a lawyer. The daughter has a lawyer. You know who's going to win in this situation? The lawyers. And I have to deal with two of them. Okay. And I do have to do a special needs trust unless in court it will get declared as not correct. But meanwhile, they're both fighting one another. All right. The last couple of things I want to talk about has to do with how you do your taxes. And I will say this up front. I'm probably as old, if not older than most of you, and I am still working real hard for a couple of reasons. One, I love what I do, and I think you can hear that. Number two, people count on me, and because I was a professor and a teacher, I run my tax business forever, but I also have a PhD and taught at George Williams and Benedictine. So the people that are my clients, they understand it, and I like to teach you. Okay. But for many of you, you try and do your own and you use TurboTax or something else. I want to talk about part of the problems. Okay. One, the software is only as good as how well you know the law. So some people think it's simple. Our tax returns seem to get more complicated every year. I think it's important if you try and do it yourself. If you call me up and you've got a problem, I can't answer it. If you've got a problem with the IRS after you do it yourself, I can't help you. Okay? And people get really freaked out that they make mistakes. If you're going to hire a person, okay, and I just want to tell you this because I think this is important. As I said, I explain it. And somebody asked me the last time, I'm probably as expensive as a CPA or an attorney, but that's because of the way I work. But there are several things that are important to know. One, you're looking at me through my computer. I have a lot of clients still, and I keep old clients in my computer. I have an IT guy that checks my computer every month. Okay? If I have all of your social security numbers, I have all of your financial documents, I have all your basic information in my computer. If somebody hacked in my computer, you'd be finished and I'd be finished. So I have several kinds of insurance that are really important besides the other. The other thing I have, which most people don't have, if you do it through TurboTax or something else, your stuff is sitting there in the middle of a cloud that's part of a public cloud. I own a private cloud that my IT person built so that my stuff is not mixed up with anybody else's. Okay? He protects, you can't see the equipment that's sitting over there in my office, but I have huge amounts of very sophisticated equipment to protect me and to protect you. And I also have two things that are really important. One, I have errors and omission insurance, so that if, God forbid, I make a mistake, which occasionally I make a small mistake, but not very often, and I would pay the tax that's due and the interest for you. But that's rare. But I do have errors, and I've never used it. I have errors and omission insurance. I also have identity protection insurance. These are things that are really important to know that somebody has. The other thing that's important for you when you are choosing somebody. If you're working with me or somebody like me, there's only me that does all the work. The people that are out in the suburbs, and I still have many, many of you, either they send their stuff into me by Federal Express, we don't use the mail, or my office manager, whose name is Beth Austin, she lives in Woodridge. People drop things off at her house. If you're older and you can't do that, I've hired her husband and he comes and picks them up. Okay, then she brings them back, or I FedEx them back to you, and I either talk to you on the phone about your tax return, or I Zoom with you. Many tax offices send out organizers. You fill them out, and they give them to somebody like Beth, that's a paraprofessional, and somebody like me sort of looks them over, and then you get them in the mail, and you have no idea what's going on with your tax return. That's not the way I know how to do taxes. And as I said, it's one of the reasons that I'm still in business, but it's real important to know that. Also, a person or a business needs to be there all year round to help you. One of the things that happened a year and a half ago, I think, a client asked me if I'd help her mother. Well, her mother died. Okay, an H&R Block out in, I don't care, Crystal Lake or someplace awful like that, did her mother's tax return for years. Her mother was dying. It turned out they discovered 3 years later, after her mother died, that they forgot to put her state of Illinois retirement on her tax return. They got a letter from the IRS with a levy because where the mother lived wasn't there anymore because they sold the house. They got a levy notice for $7,000, okay, on a bank. It took me about 6 or 8 months. Eventually, I got H&R Block to pay the tax because they made the mistake. And then I got the IRS to drop the penalty. So I was able to do that. And yes, my clients paid me, but I was able to get them to drop the money because the IRS died. So that it was a win-win, but I was able to do it. And it was because it was a client's mother. And I actually called the corporate office in H&R Block and sent them all sorts of stuff. And they had some kind of guarantee. And they've been doing this woman's tax return for 15 years. So somebody screwed up badly. So on the final side of this, I would just tell you, I used to send out in snail mail to all of you. I do a tax newsletter for my business. It's called the Strauss Report. Some of you have been around for quite a while and have seen it. I don't send them out snail mail to people from workshops, but the newest one, which is what I'm reading from now, is on my website. And I do things up to date on my website. You're more than welcome to download it and print it. At least you can see and sort of read again and say, oh my God, I'm overwhelmed by all this stuff she's told me. Maybe I'll put it away and I'll look at it later. My website is www.strausstax.com. If there's a question that you have that's sort of generic, I'll be in my office almost every day. This is my office now. Okay. And we also have a Facebook page. I don't love social media, but it's easier for me to post things real time. If something changes or something happens, I can post it real time, and you're more than welcome to like it. As I said, I don't know, there are a couple hundred people that like it. Some people look at it and don't like it. I don't care whether you like it or not, but it's a good way to keep up to date, because I do believe that in 2025, things are going to change. I don't know what's going to happen. I don't know how it's going to happen, But I am hoping that my head works well enough that I can be there for me and be there for you. It's 8:36. I want to thank you all for coming. I can see your names, but I can't see your faces. But thank you very, very, very much. And as I said, my phone number is 630-964-4018. We have ported my Downers Grove phone number to a cell phone, and either you'll get me, or most of the time Beth carries it around. And if you don't get me, Beth Austin has been my office manager now for 10 years. She's been a client probably 30. And when she retires, I'm done. Thank you very, very, very much. Good night.